down here. And I'll use these momentum lines as an example. When the dollar was still rising in price, the momentum lines here were saying, uh-oh, wait a minute, the momentum is lost. Now as we're going the other way, the price is going down, our momentum lines are saying, well, the force of the decline isn't as great as it was before. If we get a dollar rally, for who knows what reason, any reason, and I would suggest a key point is very close to where we are. We're right in the 76 and a low fraction area over here. This right here is 77.5, this last little peak. I suspect there are so many people technically watching the dollar right now. If we get a dollar rally up above 77.5 here, we might see a flood of technical orders come in buying the dollar, and it could be supplemented by what is called the carry trade. Carry trade, to try and deal with that briefly, means people borrow money. These are big investment banking firms, hedge funds, what have you, borrow money in a very cheap currency. Can't get any cheaper than the US dollar. They're giving money away for essentially zero. And then they're investing it in assets in another currency with a higher yield. And as long as the dollar stays down at virtually a zero cost, they're borrowing essentially free and making the spread. And they're leveraging it dramatically, many of them at 20 to 1 and thereabouts. So when you're 20 to 1 leverage, you don't have much tolerance for things moving against you. Which is why I say if we see a dollar break up here above 77.5, you might have a scurrying run to cover dollar shorts where the borrowing has taken place, and to do that, they have to sell the assets that they put those borrowed dollars in. And that could be world equities, that could be gold, that could be silver. Essentially, it was other types of securities. So it's just one of those, I mean, it doesn't have to happen that way, but that's just one of the lookout triggers. It could happen any day on a dollar rally, and it might be, there might be some fireworks if that occurred. By the way, we have a Fed meeting going on today, tomorrow. They make their announcement tomorrow, and securities markets frequently bounce around a lot when the Fed meets. Longer term considerations, the next page, you've seen this, any of you who've been here for a decade have seen this for a decade. Long-term cycles in the US stock market, I won't go into it tonight. Clearly, since the year 2000, we've been in a long, weak cycle. Whatever the short-term considerations are right now, we're still in an environment where profits come tougher, losses come easier when you're in a long, weak cycle. So it is one of those things to look out for. With all the talk we hear today about giant amounts of money, the quote on page 39 is quite sobering. Remember the old Everett Dirksen line, $1 billion here, $1 billion there, pretty soon you get real money? You're talking real money? Now we've upped it by 1,000 times. Now we're talking in trillions. 1 million seconds is 11.5 days. 1 billion seconds is about 32 years. 1 trillion seconds is 32,000 years. So if you spent $1 a second, it would take you 32,000 years to spend $1 trillion. We're talking big money. And how many trillions were we talking about? Just 3.7. I mean, that's a long time. Not many of us will be around when we finish counting that out. Whew. Well, we titled this talk, Massive Government Stimulus versus Unprecedented Levels of Debt, Irresistible Force versus Immovable Object. Our picture at the end of the book here isn't a perfect analogy. It's the best we could find when we were looking for immovable objects and irresistible forces. But we ask the question, which will prevail? And we don't know. And you don't know. And Tim Geithner doesn't know. And Ben Bernanke doesn't know. We know, at least we know we don't know. They may think they know. We can possibly give a few generalizations. If the stimulus wins, almost certainly it will result in inflation and potentially virulent inflation. A rising price tide could lift all kinds of asset prices. And it could also simultaneously wash away a lot of debt problems, which of course would be politically desirable. It would undoubtedly come with longer-term consequences because of how it would upset the equilibrium of the overall economy and who gains and who loses. That outcome is by no means certain, even with the tremendous flow of new money into the system. The best efforts of governments and central banks may fail, and the deleveraging process may spread and may get more severe, and deflation could become a very real problem that we will have to wrestle with more than just for the last 7 months at a small level. So what's an investor to do? We've been pretty consistent for well more than a decade in our advice that investors need to build flexibility into their investment programs. Common wisdom of our industry is to set a historically well-founded asset allocation, basically maintain it, periodically rebalance to that fixed allocation level, and that has worked. Didn't work terribly well this last decade, but it's worked for many, many decades. It's a bet that the future will look in general terms like the past. And if the future looks in general terms like the past, a traditionally based fixed allocation will probably do okay. There's a realistic possibility, however, that the system is broken. We know that less than a year ago, the system was largely broken, absent government rescue. The major banks of our world were dead without a government bailout, which of course they've gotten. There are a considerable number of very good analysts who maintain they are still dead. They're the walking dead. We have zombie banks. They claim that the bad debt that is still on those banks' books will yet bury them. Don't know. Don't know. It's not an unrealistic potential. So it's one of the things that in the broad spectrum of potentials we at least have to take account of. And we don't know how that process will end. But by staying flexible, we've been able to grow the assets of our clients from the beginning of this century to now, with a few more weeks left in the century, by about 60%. So each million has become about 1.6 million in that full, almost 10-year time period. In the same time period, a 50-50 mix of S&P 500 and the Lehman Brothers Aggregate Bond Index was up just about 30% cumulatively over that full time period. So what we did was essentially, in that period, did twice as well as 50-50 stock bond with far, far less risk exposure. We really limited the exposure to risk very, very dramatically. And we have no way to know what the next decade is going to bring about, but we do believe that avoiding the fixed allocation and entertaining, in fact, a highly flexible approach is going to be far more beneficial for you in the decade ahead. You've got to stay away from the potential big loss, and we don't know that that's coming, but that's one of the alternatives. A number of people that I've talked with recently have said, well, you talk about this being a probability business. And yes, it's very definitely a probability business. Nobody knows what's going to happen next. And let's just assume we had an 80% chance of being right in any of our decisions. Most of us would be dramatically rich in very short order if 80% of our decisions were correct. However, if in the 20% margin of error, you have the big loss, you have the potential wipeout, which is what could happen if you're on the wrong side of a system being broken. If you get dramatic inflation and you've geared for deflation, or the reverse of that. So I would suggest to you flexibility is critical right now because you can't take the big loss, and the big loss could occur on either side of that equation. So we welcome you here tonight. We welcome you to a little refreshment afterwards. We're glad you came. Look forward to getting a chance to chat with you for as we finish up here tonight. Thanks for coming.